Everyone. So we'll start off the webinar for today. So today we'll have the US weekly, the China weekly, followed by the technical analysis, and we'll showcase our Singapore 3Q equity strategy. So firstly, for the US weekly, for the past 1 week, we can see that the returns are mostly positive, except for the materials, industrials, and the healthcare. So today we'll be talking about one of the stocks, Verizon. So for Verizon, we have a technical buy rating because we think that the revenue is starting to stabilize and will grow slightly, which is as guided by the management for the past few quarters. The 5G opportunity is starting to gain traction as well, and we think that you are likely drive growth for Verizon in the long run. So it is currently trading at about 11.2 times earnings, which is below its one standard deviation of 11.85. We think that the valuation is attractive given the wireless momentum and upside from 5G. So the first long-term driver will be the 5G upside optionality. It has currently launched the 5G service in Chicago and Minneapolis, but this is mainly a test drive. And they are targeting to increase their coverage to 30 cities by year end. And we will expect that these new services in the major cities to roll out faster due to the availability of existing infrastructure. So as equipment and chipsets for the 5G may only be available late this year, likely to be the end of this year. So 5G is likely to be only an incremental revenue driver for Verizon in the long term. As for the wireless market, we think that the service revenue will maintain its growth momentum and offset the lighter equipment upgrade trends as the replacement cycle for handsets have lengthened. Verizon also noted that 50% of its postpaid base is on unlimited plans today, with a majority of the customers on its lowest tier, which is Go Unlimited. So this indicates a higher runway for wireless as customers switch to higher priced plans. In our view, we think that the wireless business is the biggest factor for near-term growth, which represents about 90% of its EBITDA. So this is the list of the upcoming earnings. And for this week, we'll be focused on the bank's earnings. And with that, I'll pass on my time to Jieyuan, who will talk more about China.
Thanks, Edmund. For the Bank of the China's, we are seeing there's a stable asset qualities, also with the healthy fundamentals. There is for the first quarters, the Bank of the China's the deposit growth are higher than the peers. With the tier one asset ratios to be remain high, still we are expecting the second quarter's room to deposit ratios will go higher. Also, compare with the others, the three national banks, the Bank of the China has there is a Bank of the China to trade at a well discount to the ICBC and the CCBs. To the ICBC is about 12%, to the CCB is about 16%. To the agriculture, the Bank of the Bank is 2%. So there's a price advantage. Also, the Bank of the China is the highest with the highest dividend yield in the national banks. In these two conclusions, we are positive on the Bank of the China's. For the stock performance last week, the CSI 300 down about 2% last week, means mainly because of the Monday's big market move downs. We're thinking there is because of the two reasons. One, we are thinking there is a control board to check the tensions of the fund, and the control board will be established on next 2 weeks. We are thinking the market was to be moving at the average. And secondly, the most investors are talking about there is uncertainty on whether US will cut down the interest rate, give the concerns about whether the RMB's exchange rate. But For the control board, in the reference of the Chinext established on 2009, we're thinking there will be a period that the market will be moving down, but after that, the Chinext will be moving in the same directions of the main board. For this 2 week, for this 2 week, it's a big week for the China's macro numbers. Also, this is the list of the upcoming earning receipts of the series in the companies, including in CSI 300. Also, some of the China companies they list on US, including like the Baidu's and iQIYI. I will move time to the Wei-Ren for the technical outlook.
Thank you, Jian. So we carry on for the technicals. So for Verizon, we are seeing a upside symmetrical triangle. So based on the wave count, we are currently forming the wave D bottom. So once this bottom is formed at $56, we will expect a strong upward movement to form wave D, and therefore retrace to form wave E, and therefore breakout of the symmetrical triangle towards $65. But however, based on the recent price action, there may be there's a strong indication that wave D might be taken out instead. So that once this bottom is formed, the price may actually have a strong rally to break out wave D. So let's move on to Straits Time Index. So for Straits Time Index, our view is still the same as sharing session on the 1st of July. Further downside is still expected, although there's a strong indication of uptrend over here. But we should be saying that price retracing to the 3,198, which is the 50 SMA region. So from there, then we will see that there may be a strong upward rally towards beyond 3,004. But however, based on the wave count and the current situation, complex corrective wave may be the upcoming price movement. So therefore, price may be ranging in between 3,600 and 2,900. But however, we believe that once price retrace back to 2008, the strong rally will happen at 2008. So for DBS, let's move on. Correction in place for a greater rally beyond $40, and $40 is just beginning of rally target. However, in the nearer short term, we will be seeing that price retracing back to $21 region, $20 and $21 region, because of the ABC corrective wave. So therefore, once price is actually hit here and test the upper trend line over here, we will be seeing the rally beyond $40. So I'll move on to Paul for the Singapore third quarter 2019 equity strategy.
Thanks, Wei-Ren. So we move on to our third quarter equity strategy for Singapore. I think we released the report on Friday. So this is just a summary of how we see the third quarter panning out. Just a very quick review of for the second quarter. The big performers were obviously the REIT stocks, and this I'm looking only at the STI components. In terms of the biggest gainers on the STI, at least in the second quarter, was Singtel, Wilmar, and of course the REITs. Most of these were company-specific reasons than any broad sector teams apart from REITs. Of course, Singtel, we had the recovery in the associates, and also for Wilmar, there was the upcoming consumer business IPO. The stocks that got hit the worst were all these below. In terms of the banks kind of underperformed. There were still positive gains, but they generally underperformed apart from SGX. This is just the next slide. Sorry for the error here. This is mainly just on by sector against telcos, and all the REITs did well. The losers were consumer. This is mainly because of Genting Singapore. The property stocks and also healthcare were also sluggish. Okay, in terms of, now move on to just a summary of our views for the third quarter. In terms of the macro backdrop right now, I think what we've seen now is that expectations are just for extended slow growth globally in the longer term, but not recessionary conditions. And that's why you can see that the equity markets can actually still rally somewhat. And also, of course, with negative bond yields for the next 10 years, you're also expecting muted inflation. So that's the backdrop. In terms of how we see the market, we are looking at really a kind of range-bound borrowing market for the third quarter. There are two reasons why we say so. I think firstly, the global economies are still drifting lower, at least for the third quarter. And also, we think that expectations of low interest rates that have actually caused the market to rally is too aggressive. I think the market's already looking at 3 rate cuts. So in a way, even though you do get 3 rate cuts by the Federal Reserves, it may not actually even move the market because these are already within expectations. Another point I want to note is that we think that probably the trade war we expect it to taper down. I think we'll show you one slide of some of the reasons why. And also our STI target is still 3.6, but we think most of the rally will probably come in the fourth quarter. Some of the catalysts we think why the rally will come is we think there could be some stability in global growth by the fourth quarter because it's quite protracted. Of course, the attractive valuations, and also we think that the one valuation upside for Singapore will be at least weaker bond yields. We'll explain why later. But anyway, in terms of for this quarter, the sector we like is actually the finance sector. We think that we are expecting better than expected results for the second quarter. Some of the reasons, of course, for SGX in particular, they already released their derivatives volume, so you can expect some good numbers from SGX, and this will offset any weakness in equity trading volumes. And moving back to the banks, why we think that the results should be better than expected, because firstly, even though interest rates globally have actually moved down, but actually for second quarter alone, the SIBOR actually rose in second quarter. It actually went up 6 basis points in the second quarter. So this will be supportive for the bank's earnings in the second quarter. And secondly, with the big global bond rally, this will boost the trading income for all the banks, probably more so for OCBC because they hold a lot of investment financial assets, and that's mainly in their insurance arm, and most of it is all held in bonds. In terms of our model portfolio, the absolute 10, we in the second quarter we were up almost 7%, and for the first half of 2019 the portfolio was almost 14%. In terms of the changes, we removed Keppel DC REIT and China Sanxin. We took out Keppel DC REIT because it really hit our target price and is really trading at I think 1.3, 1.4 times price to book. In our additions, we added DBS Group and also APAC Realty. Okay, in terms of just to go back to the themes, as you can see from this chart, global growth is still drifting lower. Sorry, actually this is actually different. There was this error here. It shouldn't be flat here. But anyway, global growth is still drifting lower, and this is not unique to Asia. It's all over the world. And also Singapore is not immune to the slowdown. You can see industrial production for Singapore continue to continue to contract, and also the worst is actually electronics. As you can see, it's going negative. It's one of the sharpest declines for electronics. The only hope we have is that this is really quite protracted. This has happened since early January, so we are just hoping that by fourth quarter there could be some stability, and some of the numbers out of China also getting to be better. In terms of Singapore GDP, as you can see, the blue line, this is Singapore GDP. For the second quarter, it was up only 0.1. And you can see since the global financial crisis, this is the weakest in Singapore for the past 10 years. This is probably the weakest GDP growth that we had year on year. And also what we do is that we look at the PMI new orders. So this is the June, this is the 1 year forward, 1 quarter forward. So June PMI also suggests that the third quarter GDP for Singapore will still be weak based on the new orders, because it has quite a good lead in terms of where the Singapore GDP will be, 1 quarter lead at least. In terms of the rate cut, like we mentioned earlier, this is the current federal interest rate. But you can see the expectations by end December is at least three rate cuts. So we think whatever interest rate cuts have really been priced in by the market. Okay, and this is our model portfolio. As you can see, the changes we did was we added DBS and also we added APAC Realty. This is the performance. Most of the gains came actually, I think, like as per the market, came in January and also in June. In terms of the teams, I think this is going to be more for fourth quarter. But in terms of the team, despite the single-digit increase in the STI, you can see that it's still, the valuation still look cheap. It's still at a 1 standard deviation lows in terms of the valuations. in terms of PE. Even when we look on a dividend yield basis, the STI looks attractive. It's still holding at least one standard deviation high, so about close to 3+ percentage points. So this is actually quite healthy dividend yields historically for the past 10 years. In terms of the other team that could help the Singapore market, at least in the fourth quarter, is that you can see these are the global bond yields. Singapore bond yields actually is still quite elevated at around 2 or 1.9 something, I think the most recent number. So despite the huge bond rally, Singapore bond yields are just still quite high compared to the peers. As you can see, like this, taking this simple gray line, this is the German bond yields. We used to track even low, used to be higher than the German bond. We used to be like even sometimes lower than the German bond yields, but of course out of QE from Germany, this actually pushed it even lower. And we also used to be lower than how all the global bond yield proxy. This is all the developed markets like US, Canada, Australia. So our bond yields comparable to most developed markets is still pretty high. So this could be one catalyst to at least help re-rate the valuations for the STI. If the global bond yields will come off, as you can see, there's a big disparity here. We are quite elevated compared to our developed neighbors. In terms of the final theme that we look at, I think probably we think that the trade war noise will probably be tapering down. Probably still some noise in third quarter. By fourth quarter, we think it will probably taper down. Firstly, as we head into the 2020 US presidential elections, as you know, no president wants to go into 2020 with a weak economy. So it will be very risky for him to flame this the trade war rhetoric again. And also, we also, one of the reasons why he probably gave some leeway to Huawei is because the US corporates are finally pushing back hard. I think just before the G20 meeting, you noticed that Apple mentioned they were actually going to move production to China. This is probably one of the warning shots. And also, Google also concerned that 2/3 of the Chinese phones are actually Android. 2/3 of Android smartphones actually come from Chinese brands. So you can imagine if most of them shift to their own operating systems. And also the Chinese are already building their own technology from Arc OS for Android and also Microsoft, and also of course the semiconductor chips. And the other point is that US corporates alone have almost 400 billion sales in China. So these are not the exports from US to China, but just US corporates' domestic sales. Like even even Apple alone is 50 billion, and Boeing is probably around 20. So there's huge sales, and the US corporates are going to be exposed if this trade war actually gets even worse, and you know, there could be some retaliation by the Chinese. In terms of, and also the other reason why we think probably the worst is kind of peaked in terms of the trade war noise is because US still has a huge reliance on China in terms of the import. So imposing tariffs on this will probably going to be difficult politically, because almost 90% of smartphones, 70% of all these consumer products used in US comes from China. So that's it for us in terms of just a summary of our fourth quarter, of our third quarter Singapore strategy. Any questions? Thanks.
This is in a very long-term projection. It's based on the wave count, actually, the alert wave count. So currently, we have, for the weekly chart, we have completed a 5-wave minor phase, and we are, once the C wave is completed over here, like I said, $20.66, we are going into the third wave of the intermediate phase. And usually third wave is the longest and the strongest wave. Thank you.
Okay, we got a question. Thank you for the question. Given the weak property sectors, right, what's the reason for adding APAC Realty to our top 10? For APAC Realty, I think for us it's partly a re-rating story, and probably the best time to buy is when volumes are actually kind of like tapering down, because as you know, this is very cyclical. I mean, there are a few reasons. Firstly, we like the huge market share. I think for new launches, I think them and PropNext probably have 70-80% market share. So they're all very dominant, number one. Number two, we like the whole metrics. I think the yield here, I think there was an error by Bloomberg, but I think they're hitting almost 9% yields, dividend yield. Even if they can't meet it, you probably hit like maybe 5 or 6% dividend yield. And thirdly, we like the whole business model. because these companies hardly use any capital. Their balance sheet is net cash. They're trading at probably single-digit PE, and also the ROE is, his ROE officially is 17, but because they've got a investment property paid by cash there. I mean, totally using cash, there's no debt. So their ROE is about 18, but the real business is probably high 20s. So we like the whole economics of the business. Yeah, you are right. Volumes are definitely down. We do track that, but we just take a bit more contrarian view. We just think that the best time to accumulate these stocks is when the volumes are down, and you just have to ride it through rather than start buying when the volumes start to pick up and the prices start to run. So that's our view for this. So we just like the whole economics of the business. Yeah, thanks for the question. Okay, another one. Are you able to advise on the latest on Thai Bev? Okay. Anyway, as you know, the run up for Thai Bev was purely the pending IPO by Anheuser-Busch, I think. But anyway, because that it was just some trading that people were doing because they were of this big listing coming out in Hong Kong, I believe. But because this IPO was cancelled, so that's why that whole trade didn't occur. Sorry, I don't really remember what's the supposed valuations for that impending IPO, but that was one of the reasons people were just trading this stock. For us, we still have a whole view on Thai Bev. There's no doubt Thai Bev is very, very strong. They got like 90% share of the spirit business, and the spirit business takes up 90% of all the profits. Not so much the beer, and they made a very good acquisition out of Vietnam. But the problem is that they acquired it with they acquired it with huge debt, and the earnings probably take another 1-2 years before the Vietnam business start to contribute. So it's still a good business, but just more of a timing issue because of the huge interest expense they're facing. So the earnings pick up from the acquisition in Vietnam won't happen so soon. So that's our general view on Thai Bev. Another question, what about Bread Talk? Sorry, we don't cover Bread Talk. Apologies. Yeah. Okay, we have another question. Again, thanks for the question. DBS, the analysis is that it is likely to move to 21 before moving up. So the recommendation is to accumulate at current price, trying to understand the two different aspects. Hold on. Sorry, I just get our chartist to explain.
Yeah, okay. Thanks you for the question. For DBS, we says that because it's based on the LOA, but as price is still forming over here, you can see over my mouse. So these are tentatively that we prefer that the market will actually retrace here.
Okay, thanks again for all your questions. Anyway, can you help can help to briefly quick explanation the Phillip Absolute 10 table? Thank you very much. Okay. Sorry, give me 1 second. Sorry, flipping. Okay. Anyway, this is basically our model portfolio. We of 10 stocks. Of course, when you build a real proper portfolio, and minimum should be 20, but we use 10 because we don't have so many good ideas in Singapore, to be frank. So how we did it is that so the analysts will pick their best stocks for absolute return, and then we just to give you an understanding of how these stocks, the teams for behind this stock, rather than just throw 10 stocks and figure out. So we try and break it down by yield. So these are stocks that we buy because of the dividend yield. So these are stocks that we buy because the dividend yield is decent and we think it can grow because there's earnings growth in these companies. And then thirdly, these are just purely growth stocks, and also these are just re-rating plays. That means like for instance, Singtel, just that it got re-rated just that because it was not doing well, but it got re-rated because the regional associates, the regional business was performing better than expectations. Likewise for Comfort, as you know, there was huge competition. Then right now there's a regulatory tailwind, and also the competition landscape has changed with the exit of Uber. So that's what we mean by re-rating plays. We will probably change this every quarter, and we will just every month we'll just through a slide just give some updates on the performance. So the assumption behind this, just to make the performance rating easier is that we are assuming 10 stocks and every stock is just given a 10% allocation in the portfolio, just to make it easier so that there's less subjectivity. Yeah, thanks. We have another question. Can you share what are the reasons why Sheng Siong is underperforming the STI index recently? There are a couple of reasons. Firstly, the macro backdrop is not positive, because I think when you look at supermarket sales, it's probably growing at low 1% or maybe flat, hardly growing. And so investors are a bit more concerned. That's number one. Number two, they've expanded their store count, but you don't see really huge growth in their numbers yet. Because the top line is growing very strong, healthily, but I think what has happened is that, as you open new stores, you take on a lot of upfront costs. I mean, a new store, even day one, you got no sales, but you still got to take on 20, 25 people headcount. So all this has been hurting their operating margins. So that's why the market is just taking a wait and see approach, because they just want to see the earnings coming for their new stores. But again, our thesis behind Sheng Siong is because in the past 7 years, they need to open 11 stores, but last year they opened 10 stores. So that's why we think that there's going to be a resumption of growth for Sheng Siong. Just that you can't expect the earnings to come in immediately in the first quarter. It takes some time. When you open new stores, you got to basically pay a lot. You got to pay up front all these expenses before you get $1 of sales. So that's why it's kind of underperformed. Yeah, thank you.
For IT, the big concerns is the whether for the questions of what's the views on IT, I think the big concerns on the IT is we're waiting for the quarterly report to see whether memberships to the fees are going up, because on the first quarters there is a big jumps on the memberships account. So we are waiting to see whether on the second quarters there is a big impact.
Okay, just a quick one. We got a question on REITs. I don't cover REITs, Natalie, but I will just do the general view, because this was in our report anyway. Hi, going forward this quarter, do you think the REITs will still do well? Which one in particular would you recommend? Any thoughts on Mapletree Lock and Parkway Life? Okay, anyway, this is just our views, because it was in our strategy report, so I'll just mention it. For REITs, the two hesitations we have is, firstly, as you know, for this quarter, as you know, interest rate the expectations are really, really high. So the REITs have already kind of re-rated due to the lower interest rate. So number one. Then number two, when we go visiting some of these REITs, the organic growth is pretty weak. I think apart from office, apart from that, most of it is very, very sluggish. So that makes us like industrial and even for retail. So that makes us very, very very hesitant to be very bullish in the REITs, especially when the whole re-rating has been due to lower interest rates. But having said that, even if there's any correction, it will be still mild. I think the reason is that interest rates is still going to come down. It's still going to stay low for at least in the immediate term. I think even if you bank in 2 rate cuts by the Fed, and by year end the ECB is probably going to cut rates also. So the whole interest rate environment is going to be low. It's going to be exceptionally low. So this will still be very conducive environment for the REITs. It's just that in the very near term, we just think that the run up is a bit aggressive, considering it's all about just low interest rates, and we don't see anything on the ground or organically, at least, of having very strong rental reversions. And of course, there could be some acquisitions, but you're using very cheap money to buy expensive assets in a way. Okay. In terms of the Mapletree Lock and Parkway Life, sorry, we don't cover these stocks. But I think next time once the results are out, and if we do participate in some of their conference call, we will just give you some of the highlights. But we don't have an official call on it. Yeah, thanks. One question. May I ask, would you consider OCBC Bank as dividend growth stocks as well, due to the bank has increased to 2.3 cents last quarter? Thank you. Yeah, I think OCBC is probably one of the another bank that probably can grow their earnings and also dividends. Just that, especially because OCBC's capital ratios is probably one of the highest among the three. Just that the last few quarters, the results hasn't been that fantastic, and that's why our preference has been more on DBS and UOB. But having said that, I think because of because they are the most exposed to the bond markets actually, because of their insurance arm. I think headline wise, they probably could get the one of the biggest in terms of headlines upside because of the big gains in trading income. But of course because so long as you grow dividends, for us it's just it will still be a dividend grower. In this kind of Singapore is growing about 1%, so any low single digit growth in dividends considered growth for us. Yeah, thanks. Thank you everyone for all your questions. If you have any more, sometimes we can't answer some of them, just put it in our stocks BNB. There's a community section there. You can actually post your questions and we will try our best to answer them. Yeah. Thank you everyone for participating. Bye.